Okay, you can see the screen.
Yes, sir.
Okay, fine. So this is the revision, okay, of portfolio management. So basically, you will find a glimpse of many other subjects also over here. Uh, so portfolio management. Now, the first, uh, few terminologies that you should be knowing is the difference between risk averse, risk seeker, and then risk neutral. So risk averse means he is he wants more returns for the given level of risk. Risk averse, that means he is not ready to take risk. That doesn't mean he will never take risk. He will take risk if he is compensated more than the normal returns. So wants more returns for the given risk. More returns for the given level of risk. Okay, that is risk averse. Risk seeker. Risk seeker means uh, he is ready to take more risk for the given return. Ready to take more risk for the given return. Okay, that means he is taking more risk than required. He wants more returns than required. So risk averse wants more returns than required, and risk seeker is ready to take more risk than required. Risk neutral is doesn't matter whatever be the risk, I will focus only on return. That is risk neutral guy. Okay. Then utility function indifference curve. Utility is the happiness utility that you get. Okay. Now, how will you uh, plot it in a graph here? So how will you plot it in a graph here? See. So this is the indifference curve. It looks like this indifference curve. So indifference curve, what does this indicate? It can differ from person to person. For another person, this might be the indifference curve, more steeper. For another person, it might be very flat. Okay. This might be the indifference curve. So indifference curve indicates what that means. He is okay with this risk and this return, or this risk and this return. Okay, and this risk and this return. This risk and this return. Okay, similarly for this guy, second guy, for this risk, for this risk you want this much return. For this risk he wants this much return. Very high return he is expecting. Okay, and this guy, he is taking this much risk, but still you see comparatively, if you see here, he is taking more risk but less return only he is getting. Okay, so you can categorize him as risk averse. So risk averse, he wants more return for the given risk. That means the indifference curve is steeper for your risk averse investors. Okay, and then for
Okay.
your risk seeker, the indifference curve is flat. Okay. Risk seeker indifference curve is flat. Okay, understood this one?
Yes.
Then some formulas. Okay, we'll come to this formulas. Before that, this two fund separation theorem. Okay, now in this indifference curve, um, if I draw a line tangent to the indifference curve, then this is the line that the investor should follow. Okay, this is optimal, this part where it is connecting tangent is called optimal uh, portfolio. Okay, optimal portfolio. So uh, this is okay. We can say optimal risk return portfolio. This one, and if he is investing below this, the curve. Let me write it like again. So here, this is the indifference curve. This is the tangent line. This line is called CAL, capital allocation line. So this shows how he should be investing. That means what is giving him maximum satisfaction, happiness. Now this is called optimal risk return portfolio. That means he is getting maximum based on his nature. He is getting maximum, sharp ratio at this point. So this is where he should be investing in. This much risk he should take so that he gets optimum return. Okay. Now, if he is investing here, that means he is very conservative. He's taking less risk than what he should be taking. Okay. And if he's investing here, he is aggressive. He's taking more risk than what he should be taking. Okay. But his utility is here. Okay. Understood this
Okay.
point? So,
Yes.
so actually what happens is everybody is investing, which is giving them maximum utility, right? So, which is giving them maximum utility. So now this two fund separation theorem says that a rational investor will be investing some part in a rational investor will be investing some part in a rational investor would be investing some part in, let's say, some part in risk free and some part in risky. So that means if this is the capital allocation line, some part is invested here and let's say some part is invested here. So let's say 30 percentage here, 70 percentage here. Okay, so now what will be the expected return then of his portfolio? Expected return will fall somewhere in between. Why in between? Because say for example, this risk-free investment that he is doing, he is getting let's say 6 percentage, and 70 percentage is investing in some risky instruments where he will he is expecting 13 percentage. So 6 percentage into 30 percentage, okay, plus uh, 13 percentage into 70 percentage. Just calculate how much it comes to. 1.8 percentage plus, just calculate this one.
9.1.
So overall, how much is it coming to? 11 percentage, is it? 10.9 percentage.
10.9.
Okay. So 10.9 falls somewhere in between, right? So this is for 6 percentage, this is for 13 percentage. So 10.9 should be somewhere in between. Is it fine? Okay. This is called two fund
Yes,
separation theorem.
sir.
Now capital allocation line means what? The line drawn tangent to the indifference curve. Why is it is drawn? Because this will tell you what is the optimum portfolio for him, which will give him maximum utility. Okay. And what is that maximum utility? Where the Sharpe ratio will be maximum. Okay. Then some formulas were there, right? Okay. So coming to this formulas, expected return. Yeah, this is this formula only. Weight of A into expected return of A plus weight of B into expected return of B. Is this okay? Weight of
Yes.
A, here it is expected return of A, weight of A. Expected return of B, weight of B. Okay. Then standard deviation of the portfolio. So standard deviation of a portfolio means here assumption is two assets only are there. If only two assets are there, standard deviation of a portfolio is equal to root of weight 1 standard deviation 1 square plus weight 2 standard deviation 2 square plus, because there will be correlation between them. So plus 2 into weight 1 into standard deviation 1, weight 2 into standard deviation 2 into R. Okay. Now in this case, allow asset B to be risk free. So if one of the asset is risk free, then what will happen? If it is risk free, its standard deviation will be 0.
Yes.
It will be 0. This will be 0. So it will be root of weight 1 standard deviation 1 square. Square root cancelled. So standard deviation of your portfolio will be weighted standard deviation of the risky asset. Here, WA standard deviation. Is it okay?
Yes, sir.
Then, so this also I told you. This is steeper, flatter, and then that indifference curve. Okay.
Okay.
You can read this quickly. See if you are comfortable.
Done, sir.
Okay. Fine. Then this is all okay, right? This is variance. Instead of n, they have used t. That is fine.
Yes,
Okay.
sir.
Then covariance. You want me to explain anything here?
No, sir.
Covariance formula is all okay, right? Correlation. But these are all very important. You will for sure get 1 or 2 questions, okay, from this
Okay.
page. This one. You should read this very carefully. Theoretically, they may ask questions. High chances are there. All these are important ones. Then variance of your portfolio. So now I can change this formula also slightly. Now, if this is the formula, original formula, okay, I'll just rewrite again to avoid confusions. Standard deviation of your portfolio is equal to root of weight 1 standard deviation 1 square plus weight 2 standard deviation 2 square plus 2 into weight 1 standard deviation 1 into weight 2 standard deviation 2 into R. Now how I can rewrite this further is, this is standard deviation, okay, and root of weight 1 standard deviation 1 square plus weight 2 standard deviation 2 square plus 2 into weight 1 standard deviation 1 into weight 2 standard deviation 2 into covariance by standard deviation 1 into standard deviation 2. So this gets cancelled. See, I don't even bother to remember these formulas. I know only this formula.
Yes.
Based on this, I just create all others depending upon the question. Okay, so you may
Okay.
follow whichever way you want. If you want to remember, you remember. Otherwise, there is no need actually. So now this is what I do. If I have to, find out, I may take 10 seconds more, but doesn't matter for me because I don't want to go through the pain of remembering. Okay. Covariance of 1 comma 2. It's 1 comma 2. So this is the formula for standard deviation of the portfolio. So variance of the portfolio will be what? So this root will go away.
Yeah.
So weight 1 standard deviation 1 square plus weight 2 standard deviation 2 square plus 2 into weight 1 into weight 2 into covariance of 1 comma 2. Okay, this is the formula. Then this p 1 comma 2 means correlation. Okay, this is correlation only. Then variance of the portfolio also. uh, so this is also normal. You want me to explain anything here? This is just whatever I have written, that one only.
Yes, sir. It's fine.
It's fine, right? Okay. Then efficient frontier. Again here also, um, if correlation is 1, then what? Okay, if correlation is 1. So if correlation is 1, so again I'll write the formula. Standard deviation of the portfolio is equal to root of weight 1 standard deviation 1 square plus weight 2 standard deviation 2 square plus 2 into weight 1 standard deviation 1 weight 2 standard deviation 2 into r. If r is 1, then what will happen? Weight 1 standard deviation 1 square plus weight 2 standard deviation 2 the square plus 2 into weight 1 into standard deviation 1 weight 2 into standard deviation 2 into 1. 1 means what? All this will be same number. So now it is in the form of a square b square plus 2ab. That means root of a plus b the whole square. A plus b the whole square. This step is okay.
Yes.
And so this root and square will get cancelled. Okay. So it will be weight 1 standard deviation 1 plus weight 2 standard deviation 2. This is the formula. This one.
Okay.
Here it shows if the correlation is negative, the standard deviation will come down. That is the takeaway point. Right? Okay.
Yeah. Hmm.
This graph you can ignore, not needed only. The same thing only they have projected in the graph, but you can ignore that one. Then this is minimum portfolio, modern portfolio theory, MPT. Modern portfolio theory, or also called Markowitz uh, theory. Okay. So this one says, I think I showed it on the
Excel.
Excel, right? But yeah,
Yes.
that time we didn't get perfect one because it was giving all negative returns.
Hmm.
It was giving like this kind of this one because everything was negative returns, na here.
Hmm.
That nothing was going like positive returns. But otherwise, it will be like this, this way. And if you draw the line, so this is assuming the market is rational. If everybody is having homogeneous expectation, that means for the given risk they want high returns, then this is the best one. This is the best one. Okay, the line drawn tangent to uh, 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 the line drawn tangent to the efficient frontier, this is called efficient frontier. Okay, this part from here, these are all efficient one. The line drawn tangent to the efficient frontier, okay, is called as what? CML, capital market line. Capital market line. Okay, and this is called global minimum variance portfolio. Global minimum variance portfolio. Okay, and all these are inefficient. Inefficient. Inefficient, nobody will ask you, or maybe they might ask also that portfolios below the efficient frontier will be called as what? Inefficient portfolio. Okay,
Okay.
inefficient portfolio. And this entire part, entire C, this part, this is called minimum variance portfolio. Minimum variance portfolio means entire thing. Out of that, the upper part is called efficient frontier. This one is called global minimum variance portfolio. Global minimum variance portfolio means the portfolio with the lowest risk. Portfolio with the lowest risk. So if they ask portfolio with the lowest risk, then they are talking about global minimum variance portfolio. Portfolio with the lowest risk. Okay. Minimum variance frontier, minimum variance portfolio, or minimum variance frontier. Okay. This is okay.
Yes, sir.
Okay. Now, if we want to draw, the equation for this CML, it will be equation will be the returns will be risk free, because this is risk free, plus the equation will be so yeah, this is the equation. So equation, we are taking standard deviation. This is standard deviation of the portfolio. Yeah, standard deviation of the portfolio into return of the market minus risk free based on standard deviation of the market. Okay. Standard deviation of the portfolio. Okay. So this is the standard deviation. Okay. So this the y-intercept is RF. Okay, this is y-intercept. This is fine.
Okay.
Then the slope rise over run of this line is, so these are called slope. This is the slope. Because this much, every time the standard deviation is going up, this much returns will go up. Okay, this is the slope. Okay, till here it is fine, right? Okay. Now
So
same,
this formula is y is equals to a plus b into x, and a is the risk-free rate.
yeah,
Okay.
yeah, yeah. Similar way, you can also think for CAL. Okay, so for CAL, this is CAL. That means this is the indifference curve. For CAL, this is the returns, and this is the standard deviation. So yeah, CAL also in the same way only. It will be same. Yeah. Then for SML, SML, this is SML. This is written security market line. Here the denominator will be beta. So here this required return will be risk free plus beta. Just like here we took standard deviation.
Yes.
Similarly, we will take beta of the portfolio or beta of the stock into RM minus RF divided by beta of the market. And because beta of the market is always 1, so I can rewrite this as RM minus RF. Is it okay? Fine.
We are taking beta to know the diversification or the volatility of the securities.
Beta is telling you the sensitivity of the stock or the sensitivity of the portfolio. Volatility, yeah, volatility means standard deviation. Okay, standard deviation includes both systematic as well as unsystematic risk.
Right.
Beta indicates only systematic risk.
Okay.
Okay, so if you see, both are quite very similar one, very similar one. See, this is same, this is same, this is,
Yes.
I would say, similar. Here we are taking standard deviation, there we are taking beta,
Right.
divided by, there we took beta of the market, we here we took standard deviation of the market. So it's very
Yes.
easy to remember this one. Okay, then similarly another one also, this is called characteristics, securities characteristics line. Here will be RI minus RF and return, here it will be RM minus RF. So excess return of the asset over the excess return of the market. Okay, that's what securities characteristics line. Okay,
Okay.
so now we will just see these formulas. This we have already done, right? This one.
Yes.
Okay, then this also we have done. One of the asset is risk free.
Yes.
This also I told you that weighted average expected return will come somewhere in between. Okay, so this part you are investing, this part you are investing, finally you will get these returns. Capital allocation line. Okay, you can see the articulation, how they are articulating. See,
Okay, sir.
yeah, same way capital market line we have already discussed this one. These are some terminology: lending portfolio, borrowing portfolio. In short, lending portfolio means you are investing your money. Borrowing portfolio means you are borrowing and investing. Leveraged portfolio. Okay, leveraged portfolio.
Okay.
Just hold on 1 minute. Okay.
Hmm.
Okay. Here, then I believe you know active, passive investments, all this, right?
Yes.
Then unsystematic risk and systematic risk. So standard deviation consists of, standard deviation is the total risk. Okay, so total risk consists of, just hold on 1 minute.
Okay, sir.
You can see the screen, right?
Yes,
Okay,
sir.
so this is total risk. Total risk consists of systematic risk and unsystematic risk. Systematic risk is standard deviation, unsystematic risk is company specific risk. Okay.
Okay.
So systematic risk is, these are all different names. Systematic risk means non-diversifiable risk or market risk. Unsystematic risk means unique, diversifiable or firm-specific risk. Now this total risk is the addition of both systematic as well as unsystematic. Okay, and graphically, if we show uh, graphically, it is like this. This is uh, systematic risk. So all these are systematic risk. So no matter how many number of quantity of securities or how many number of securities that you buy here, your systematic risk remains the same. Systematic risk remains the same. Whereas uh, this is this is the total risk. Out of that, this part is systematic risk. And this part is, let's say, unsystematic risk. Now this unsystematic risk will keep coming down as the number of securities are increasing. Okay, so it is coming down. So for this much security, this is the unsystematic risk. If you have less securities, this much is unsystematic. If you have more, this much. So, but unsystematic risk remains the same. So if you have approximately around 30 well diversified stocks, then your unsystematic risk is almost nil. Your portfolio is exposed to only systematic risk then.
Okay. Uh, but how does that happen? Like, why does it become zero?
Unsystematic risk because you have all varieties of stocks, right? If one stock is not performing well, another stock will perform well.
Okay.
All different types. 30, imagine 30 companies are there. If imagine pharma has some problem, some bad news within pharma in that particular company, because unsystematic risk is company specific, no? So if one
Right.
company has particular problem, company specific problem, another company will have company specific good news also.
Yes. Okay.
Company specific good news will also be there, right? So it gets compensated there. But if there is a problem in the market itself, then this will also, pharma will also go down, bank will also go down, or FMCG will also go down that way.
Okay.
Okay, say for example, normally here imagine you are having infrastructure company. Now this infrastructure company, if it is going down during bad time, quite possible that pharma will go up then. It is all well diversified one. Okay, so company specific risk will be highly mitigated if you have all well diversified portfolio.
Okay.
Then multi-factor uh, model. Multi-factor model means even CAPM is also a model only, but it is a single factor model. That is what based on only beta. Okay, so beta. Similarly, so CAPM model is R is equal to risk-free plus beta into RM minus RF. This is single factor model. That means this is the only factor. Equity risk premium, or also called market risk premium. Equity risk premium, or you can say market risk premium also. And second one is Carhart model. Carhart model is RF plus beta into RM minus RF. That means equity risk premium you are taking, plus you are also factoring in small minus big. That means company size, large cap, small cap. The company size of the company, large cap, mid cap, small cap, plus beta of HML. That means high book value to price. If it is high book value, it is an undervalued stock. Okay, so HML means high minus low, high book value to low book value. So that means undervalued stock. You are leaving undervalued stocks and you are coming here. So you need more returns for that as well. This is Carhart model. Sorry, not this is not Carhart. This is called Fema and
Farmer
Finch model.
Finch. Yeah.
Okay. Then Carhart model is same thing. Along with that, one more plus beta of winner minus losers. That means momentum stocks. Apart from this, you can use any other model also, or any other any other factor as well. Okay, so all will be considered as multi-factor models. Okay, then market model means it is the same one but in a different way, little different way. It is not same, I should say, little bit different, because market model means the simplified form of a single index model is the market model, which is used to estimate a securities beta and to estimate securities abnormal returns based on actual market return. See, here it says return market model. Alpha plus beta into RM, that's it, plus error. Okay. This alpha and slope are estimated from historical. This is linear regression. Okay.
Right. Yeah.
Linear regression. So using linear regression, you are finding this market model. Based on the market, so it is market model. You can think like that. Is it okay? Fine.
Yes, sir.
Then beta is covariance by variance. You want me to explain anything here? Here,
No,
what
sir.
you can remember here is one thing, the different formulas. See, I just derive this one. See, beta is equal to covariance by variance of the market. And here it is stock and market. Okay, beta. So then uh, then this is correlation. Correlation is equal to covariance by standard deviation of x into standard deviation of y. So standard deviation of x means, let's say, that is market, y is stock. Covariance of standard deviation of market and standard deviation of stock. Okay, this is stock comma market. So now based on this, I can say, see, covariance is equal to beta into
R.
beta into variance. Covariance by variance, beta into variance of the market. Okay. That means beta into variance of the market. Now instead of this covariance, I can rewrite as covariance is equal to yeah. So beta into standard variance of the market divided by standard deviation of the market into standard deviation of the stock. So this gets cancelled. So beta by standard deviation of the market, R is equal to beta, have I done rightly? 1 minute. Feel little different. I feel here. Wait. Covariance. This is correlation. Correlation. So beta is equal to this formula is right. Then so covariance is equal to beta into variance of the market. So this is also right. Correlation is equal to covariance. This is also right. So finally, beta is equal to, okay, yeah. That is because I need to find out what beta is equal to. So I can
Okay.
say, this is also correct only. And then I can say beta is equal to R into, beta is equal to R into standard deviation of the market. Okay, the mistake that I made is here still there is, let me just write again. I'm just, the notations is making me a little uncomfortable. Wait. Uh, covariance, not covariance, correlation. Beta is equal to, um, beta is equal to covariance of x comma y. Let's say x is equal to market. I'll write here because otherwise I become a little confusing for me. And y is equal to stock. So covariance of market comma stock. Covariance divided by variance of market. Yeah, market means x. Variance of x. Then R is equal to covariance divided by variance, covariance divided by standard deviation of x into standard deviation of y. Hello, can you hear?
Yes, sir.
So now uh, I can say covariance of x comma y is equal to beta into variance of x. Beta into variance of x. Okay. So here r is equal to beta into variance of x. Variance of x means I can write like this, divided by standard deviation of x into standard deviation of y. Now this gets cancelled. So r is equal to beta into, right, standard deviation of x divided by standard deviation of y. So standard deviation of x means standard deviation of the market. This is what it is.
Okay.
No, 1 minute. Again, I'm making the same. I'm supposed to calculate for beta. Not this is right only, but I'm supposed to calculate for beta. So beta is equal to r into standard deviation of y divided by standard deviation of x. So standard deviation of, yeah, right, r into standard deviation of y divided by standard deviation of x is market. So this is standard deviation of market. Y is stock. Beta. Okay, yeah. R into numerator is standard deviation of I means stock. Standard deviation of y divided by standard deviation of market. So I did all correct only, but again and again I was ending with R. I'm supposed to end with beta. So beta's value they have given here, beta. So multiple formulas. See, this formula is also there. This formula is also there. You have to know both formulas. But as I said, there is nothing you have to remember here. If you know the basic this formula and covariance is, yeah, only this formula and this formula, we can derive this formula with practice.
Okay. So I'll just write this down.
Huh. Okay, you just take a minute. Okay, let me write it down. I'll come back.
Okay, sir. Done, sir.
Hmm. So if you practice this 2-3 times, it will become very easy. So there is nothing for you to remember in all these formulas. Okay. On that
Okay.
basis only, these sums are done. Then this one is securities characteristics line. That also I told you. Okay. So slope of this. See, when we say beta, beta indicates slope. Okay. So beta is equal to covariance by variance. That's what is indicated here. This is nothing but beta. Slope is beta. Okay. Okay.
Okay.
Then this also just some time back. Acha, we did SML, but I didn't tell you from covariance perspective. So let's quickly do again. SML. Return, expected return, and this is beta. So R is equal to RF plus beta into RM minus RF. Now this beta I can write as covariance by variance, covariance by variance, variance of the market. This is what they have mentioned. Understood this one?
Yes, sir.
This is beta only, na? This is slope. Beta is slope. Okay. See, this is defined as beta. Beta, standardized measure of systematic risk.
Okay. Yeah.
This one, uh, like it's a theory, assumptions of CAPM. I wouldn't say very high probability, but then I wouldn't even completely ignore also. Little, less chance. I would say like once you may read it. Okay.
Okay, sir.
If at all they ask, but less probability only, but completely instead of ignoring, uh, you may read it just once. Then here comes Acha. No, this is all this this sum or you want me to do this sum? This is based on SML only.
I think we've done this. It's fine.
Yeah, it's a simple sum only. Just based on that SML, we have to calculate whether it is. We have to find out whether it is undervalued or overvalued. Okay. But if you face problem, you feel free to tell me. Okay.
Okay, sir.
Just one minute. 1 minute. You just read this M square in the meanwhile. Okay. 1 minute.
Okay.
Huh. So this one m square alpha. So m square alpha means what? Now this is connected to Sharpe ratio. So Sharpe ratio tells you, Sharpe ratio's formula is return of the portfolio minus risk
Yes.
free divided by standard deviation of the portfolio. Or I can even say return of the stock minus risk free rate divided by standard deviation of the stock. Or I can say risk of the return of the market minus risk free rate divided by standard deviation of the market. Okay.
Okay.
Basically, right now we'll stick to this portfolio. Basically, Sharpe ratio alone, standalone, it is good for nothing. Then I will not be able to decide anything. Okay, I'm supposed to compare it with other portfolio Sharpe ratio and then find out whichever is the maximum one. Okay, so imagine Sharpe ratio for the first portfolio is, let's say standard deviation is 20 percentage, and the numerator uh, excess market return is, let's say, 10 percentage, then it will be 0.5. Then there is Sharpe ratio for the second portfolio. Here it is 25 percentage, and here it is um, 15 percentage return. Just calculate this, how much 15 by 25?
Point 0.6.
So 0.6. So here second portfolio is a better one. So I have to compare, then only it makes sense. Okay.
Okay.
Now, so this is giving you the result, like which portfolio is better. Same way, m square alpha also will give you the result, like which portfolio is better. But here the formula is, so first I'll tell you graphically, it will be easier to understand. So here it is for those people who are really good to predict the market, like their prediction power is better than the market. So this is for the market, CML. But then when your CAL is more than the market, then what should be your strategy? If your CAL is more than the market, so that means, for imagine you are taking this much risk, for which you are already getting more returns. This is risk free. So what you can do is you can borrow money and take this much of risk. And so your returns will come this much now.
Okay.
Okay. So this will be return of the portfolio. So this is the extra. This is called M square alpha. M square alpha. And this entire thing is called M square, this entire return. So M square is equal to risk free uh, plus standard deviation of the market, this much returns, this much risk you are taking. Yeah, standard deviation of the market, and then return of the portfolio minus risk free divided by standard deviation of the portfolio. Now this, if you see, this is very similar to what Sharpe ratio, actually this is Sharpe ratio only.
Yes.
Sharpe ratio. Okay. Yeah. So risk free plus standard deviation of the market into Sharpe ratio also, I can say. Now, because this is, any portfolio you take, risk free is going to be same. Standard deviation of the market is going to be same. So whichever portfolio has higher Sharpe ratio, higher M square you will get. So when it comes to selection of the portfolio, it is what? It is equal to whatever be the SR, that only you are going to select. Whatever be the higher Sharpe ratio, that only you are going to select.
Okay.
Fine, you understood the logic.
Yes.
It is giving you the same, selection criteria, selection point of view, same ranking it is giving you. Okay, the only thing is it is giving you an idea that if your CAL is more than the CML, you should take more risk, so that you are taking risk equal to the market, but you are getting more higher return than the market.
Okay, sir.
This is what they have given in all these things, and this is an example also, some numbers they have given. Okay, here is the formula. Now what you should do is you should write all this formula in a single page. Which formula? This formula, CML's formula, CAPM's formula, on a single page you should write. So then you will know the differences, because all these formulas are very similar as well. Otherwise, you will get confused.
Yeah, okay.
Okay. CML's formula, if you note, you know how it is, CML risk free plus it was standard deviation of the portfolio into return of the market minus risk free divided by standard deviation of the market. This is CMLs.
Yes.
Okay, I'll just show, or we will check here only. See this one, standard deviation of the portfolio, and here market. So standard deviation of the portfolio, market, and here standard deviation of the market, portfolio. So it's quite similar. So that's why you should write on the same page, then you will get the clarity. Okay.
Okay.
So that's why if you get the whole, it becomes easier to connect. The only problem in portfolio management is they will play with words. It is technically it is very easy. Only the way we saw some words like risk management the other day, risk management,
Yes.
where they connected with returns. Such kind of words, if it comes, then English wise it will be a little bit of challenge. Technically, I don't see any challenge in portfolio management. Okay. Then uh, trainers measures and um, Jensen's alpha. Jensen's alpha means Jensen's alpha is equal to Jensen's alpha is return of the portfolio minus CAPM. Okay, that means return of the portfolio minus required return. Required return. So if return of the portfolio is 14 percentage and required return is 12 percentage, alpha is 2 percentage.
Okay.
The next one is trainer's measure. Trainer's measure means trainer's ratio, also called trainer's ratio. Trainer's ratio means return of the portfolio minus no return of the market minus return of risk-free rate divided by beta of the market. Okay, which is what in this case beta of the market will be 1. Or I can say return of the portfolio minus risk-free divided by beta of the portfolio. Or I can say return of the asset minus risk-free by beta of the asset. Okay, that means the base is beta. Okay, instead of standard deviation. If it goes as standard deviation, it becomes Sharpe ratio. So Sharpe ratio and trainer's ratios are like brothers that way.
Okay. But then what is trainer's measure used for?
Okay, so based on the beta, how much extra returns you are getting, excess returns based on the beta. So
Okay.
this is what we do in CAPM also. No, see
Yeah.
what do we do in CAPM? CAPM is R is equal to risk free plus beta into RM minus RF. Correct.
Yes.
Now, now here RF plus this is, let's say, beta of the portfolio, right? This is beta of the portfolio. Now, actually, the formula is like this: beta of the market. But beta of the market is 1, so we ignore it. So
Yes.
I can say it is risk free plus beta of the portfolio into, I can say, trainer's ratio.
Yes. Yeah.
Okay. So trainers, so CAPM is made of what? Trainers ratio.
Okay.
So they may ask you one question like, which of the below will not use, uh, let's say, which of the below will not use trainers ratio? Uh, Option one is M square. Option two is Sharpe ratio. Option three is trainers ratio. Then which one will you select?
Which one will not use Kaplan?
Which one will not use trainers ratio? Acha, trainers ratio I have mentioned here. Okay. M square, Sharpe ratio, and then kappa. If they ask like which of the below will use trainers ratio, then kappa
Kaplan.
uses trainers ratio.
Okay, yeah.
Okay. Then portfolio management. So from here on, all theory comes up. Okay. So here it is all wording. The way they will try to confuse you with words only. Okay. Here diversification ratio, there is only very few here technical terms. So diversification ratio, even though I have not seen this question anywhere, diversification ratio is uh, okay. So standard deviation of an equal weighted portfolio. So standard deviation of equal weighted portfolio divided by uh, standard deviation standard deviation for the nth stock. So standard deviation for the nth stock. So lower it is better. This is this is a very important one. Okay, so three major steps in the portfolio management process. First is planning step. Okay, planning. This is portfolio management process. Planning step. In that planning, we have investment policy statement, IPS, very important one. Then second one, execution step. And feedback step. Okay, these three are very important one. But here everything is all about wordings. Okay, now here you want explanation anything here. Here, see, for this one, you should read it from the curriculum itself, okay, rather than relying on the textbook. This particular points. Then endowment foundation, you need explanation on this one. Hello,
No, sir.
no, okay. Then you just tell me anything anywhere else you need explanation. Defined contribution, defined pension plan.
No, it's fine.
Smart beta means there are many mutual funds who are trying to capitalize on the beta, various beta. That can be momentum factor, then that variability factor, volatility factor, then uh, then FEMA and French model. Those are all beta only, smart beta.
Okay.
FEMA and French Carhart, all those are smart beta. And this is all mutual funds, alternative investments topics. I think next one, okay, basics of portfolio planning and construction. So again, IPS related, it is better to read from the curriculum. Then risk objectives, absolute risk and relative risk. Absolute means my portfolio should not go into negative. It is absolute. Now, if I say my portfolio should not lose more than the Nifty, then it is relative risk.
Relative.
Okay, so in relative, I'm comparing myself with another benchmark. Okay.
Okay.
Then ability to bear risk and willingness to bear risk. Okay, so ability to bear means they don't have money only. Okay, but they might be interested in taking risk. Then willingness to bear risk means they have money, but they don't have the willingness to bear risk. There. Like for example, old person uh, might have money, but uh, they have the ability, but uh, willingness. No, for the old or young person, if you see, they will have the willingness to take risk, but they don't have the ability. Which it can be no young person. Um, for a young person, ability will be there for a young
Yeah.
person, but willingness may be there, may not be there. Okay. Then rest all are plain English stuff only. Strategic asset allocation means based on the goal. You are based on the goal. You know how much percentage should be invested in equities, bonds, and gold. Okay. Then tactical asset allocation means short-term one, based on the current scenario. Say for example, now a lot of so I might not be interested in any visa company now because of all Trump tariff and H1B visa issues and all. Okay,
Mm.
so or I might be interested in when there is uncertainty, war going on. So till everything is sorted out, I will invest into gold. Now, people who invested in gold in the last 1 year, they have got good returns because of all the uncertainties around the world. Okay.
Okay.
Then risk budgeting. So you have to be careful with the wordings over here. Here it is all about wordings. So here risk budgeting is overall risk limit.
So on the previous page, I had a doubt.
Ah, what is the doubt?
The correlations of returns within the asset class should be relatively high. That strategic asset allocation.
Right. Yeah. What it means is imagine equity is there, bond 60 percentage into equity, 30 percentage bond, 10 percentage into gold. Now within the asset class correlation should be high. That means what equities within few equities are there, right? So
Yes.
their correlation should be high. Okay, within the
Okay.
asset class. But asset class to asset class, it should be low.
Okay.
Okay, correlation should be high within the asset class. Because here it is negative correlation, then this equity will not go up very highly, because already
Yeah.
you have hedged by taking negative correlation between asset class to asset class.
Right. Okay.
So that's why within the asset class, then see, between the asset class already you have taken negative correlation, then within the
Yes.
asset class there should be high correlation, na? Then only it is the right mix.
Yes.
Okay, just give me 1 minute, I'll just connect the charger to the laptop. 1 minute. Okay.
Okay, sir.
Okay. Huh. That's it. You understood this one is okay.
Yes.
Yeah. That question is also there in the website, I think somewhere.
Yes.
Then this ESG you may read positive screening, negative screening. Positive screening means which are following that ESG. Negative screening means which are not following ESG, like mining companies, alcohol companies. So the behavioral biases of individuals. So cognitive error and emotional error. Cognitive is all logical problem. Emotional is intuitions, feelings, impulse. Okay, all emotions related one. So here, you will find a lot of overlapping terms now. Conservative means you are not ready to change your thoughts. Conservative. So initially you are not okay with government company, and forever you are not okay with government company. Then again, when good times for government company comes, you will miss the bus. Then representative bias. So representative bias is in base rate neglect and sample size neglect. So base rate neglect means, imagine you have, like, say for example, you are not keeping well and you have scored very less in a test. Okay. And then you become, all right, and then you are writing the test, and then jump up happens. Now now I have to understand that this, there is a base rate representative biasness. I cannot say you have, let's say you are scoring 40 and here you are scoring now 80. I cannot say 100% jump. It has representative bias. Why? Base rate neglect, because it was not your core performance first of all to get 40. It is because you are unwell, you scored 40. So I cannot say that is, 100% jump in your performance. Understood this?
Yes.
Similarly, after COVID also, GDP was going up in double digit. Why so? Because during COVID it came down highly. So after COVID, when people started again spending money, it jumped up very high. But it had what? Base rate neglect, representation, wrong representation. Okay. Similarly, sample size. Like I asked it to a couple of people only about whether your college is good or bad, or your company is good or bad, and on that basis, I'm continuing, and I have framed a thought. Okay.
Okay.
Then illusion of control, kind of overconfidence, that you are having very less stocks in your portfolio. That is also illusion of control. Okay, some people, they will invest only in 4 5 stocks and or 10 stocks. Ideally you should have around 30 stocks. It should be a well diversified one. Okay, so if you are having very less, 5 stocks or so, 10 stocks, then it is what? Illusion of control bias you have. That because even if one or two stocks goes bad there, any negative news comes, your portfolio will be highly impacted then. Okay.
Okay.
Then hindsight bias is selective memory. This here you will not find any problem. This kind of thing, only when you face questions you will have problem. So this is more to be learned. Once you may read, but there is no point reading again and again. How the strategy should be is, You should read quickly. You should read this part once, this theory part, very quickly. Just very quickly you have to read. Then you attempt the questions. Then when you get stuck up, then again you come back to this theory and read only that particular theory. You will know what is the twist there. Okay. So while reading first
Okay.
time, don't spend much time in it while reading first time. Just quickly you should finish up reading just to get the feel that okay, I have read, rather than saying without reading um, I went for the test also.
Yes.
Okay. Then anchoring and adjustment, that means conservative. Mental accounting, mental accounting.
Yes,
Yeah.
using
Then
different.
yeah, money is money. It doesn't matter whether it is coming from this pocket or that pocket. I cannot say like, money is coming from that pocket, so it is less important. Money is coming from this pocket, so it is more important. Let my money come from bonus or salary. Both are equally important to me. I cannot say bonus money I can, take more risk, and salary I should not take risk. That is my mental accounting. Okay. Then framing bias, the way words will be framed, we fall prey to that. Availability bias is again hindsight bias kind of thing, selective memory. Whatever is available in front of our eyes, accordingly we will go. Loss aversion, this is our hypocrisy. Okay, human beings are hypocritic, right? That profits happy, loss we are not sad, we will go into coma then. Okay, so we don't want to see losses, we want only profits. That is hypocritic behavior of investors. Self-control, status quo. You want explanation on anything here?
No, sir.
Endowment means what?
When like a grant or
Yeah,
hello,
yeah. When grandfather.
grants given to
Hmm.
grants given to university or scholarships given by universities.
No, no, no. That is endowment. That is right. But here endowment means what? Here
Emotional attachment.
endowment means, imagine your grandfather has gifted you a stock. Now you don't
Mm.
want to sell that because your grandfather has gifted you, stock. That is
Yeah.
endowment buys here. So that is another one, endowment. Okay, this is another one.
Yeah.
So here it is all emotions. There it is all about funding, how the money is coming, right? Foundations and endowments. Here it is all emotional stuff. So your emotion here, it is what? That my father has gifted me this stock when I went to the college, so I will never sell this stock. Probably that stock is not doing very well now, but still you are emotionally attached, na? Understood this one, endowment?
Yes, sir.
Regret, aversion, bias, do nothing out of excessive fear. This kind of words you have to know. Herding behavior means following the crowd. Halo effect means there is a good stock, all things are looking good, but all good ratios only make it bad. Why? Because it will become over expensive. So that is called halo effect. That means all its good points only now making it bad to invest in now. Okay, that means the company is
Yes.
so good that the price has become very expensive now. Then that is halo effect. Now it is bad. Why? Because it is too expensive. Then home bias
Okay.
is whatever you are using in your home, like Colgate or bike or anything that brand you are using in your home, you are buying only that. Introduction to risk management. Again, here you have to be careful with the wordings. Here all it is all, again, you will learn only from the questions here. Okay, this is just quickly you have to read and come to the questions, and then you come back and then see what mistakes you are making, and how to then understand. So governance. So you have to go with the words, like what words they are using. See, governance is determination of risk tolerance. Okay.
Okay.
Then budgeting is allocating firm resources. Then financial risk, just remember these three: credit, liquidity, and market risk. Rest all are non-financial risk.
Okay.
Cyber security comes under operational risk. Remember, this may be tested, okay? Standard deviation, beta, duration, this all uh, you should know now, right? This one,
Yes,
okay.
this is fine.
You want me to explain anything here? Delta, gamma, vega.
So conditional var.
Uh-huh. Did you see the video? One video I sent to you, right?
Yes.
You see, that is actually, I made it for level 2 people, but then even level 1 people can see because they are using these terms now. Var. Okay, conditional var means, see, first of all, var can be found out in three ways. It is not given that much here, but it is better to know. But one question for sure will come. So that's why more you
Okay.
read about var, it is good only. Your confidence level will go up, and when you get complicated question, quickly you will solve and move on. So that's why more you read
Mm.
about war and conditional war, it is good only. That's why I sent that video to you. Okay, so war, one is historical way, historical method. Second one is statistical, that means formula based one. Third one is Monte Carlo, Monte Carlo. So this will tell you, var will tell you minimum amount or percentage of loss, or percentage of loss, minimum, and then probability, like 3 percentage, 5 percentage. Okay, example. Then time period, 1 month, 1 year, 1 day. Okay. So here, if this is var, okay, if var is hit, then further how much loss you can make, expected loss, further average loss, how much can you lose further amount. Okay, say for example, you know, minimum percentage is, let's say minimum you are going to lose something like uh, 5 percentage. So 5 percentage if you are losing here, further how much can you lose? That is called conditional var. After losing, after hitting var, value at risk, further how much can you lose?
Okay.
Okay. Like you must have, I don't know whether you, if you read newspaper, you will know that technical analysts will predict like this. They will say market, if market breaks, now let's say market is at 25,000. If market breaks this 24 500 support, it will further come to 24 100. So if it touches here, further how much it will fall down, they will predict
Okay.
conditions. Okay.
Given that the minimum
After
loss is this much.
war is,
Yeah.
after war is, so it is like, this is war. If this is broken, further you are expected, market will come down this much. So this is conditional war.
Okay.
There they use resistance and support, but here just similar analogy I'm drawing. Okay.
Okay.
Okay. So more you read, it is good only. You read from Google or anywhere little bit more also if you are not okay with this, or you ask again. Again, I will explain it to you. Okay, but for sure you will get one question: conditional war
Okay.
or war. Understood this much? The keyword is expected return. Okay, and it is what, after the war is hit. After the
Okay.
war is hit, how much average loss you can make further. Fine. Okay.
Yes, sir.
Then next one, stress testing, scenario testing. These are all self-explanatory. Stress testing means one particular variable, extremely if it is volatile. See nowadays now H1B visa. Now if that one
Yeah.
variable is volatile, how it is going to impact IT company? They will check,
Yeah.
because now they will not be able to uh, hire Indian employees over there in US. So how it is going to affect? That is called stress testing. Scenario analysis means multiple variables they will check. The relationship between India and US is gone in all aspects. Be it import export, be it IT or anywhere. Then uh, scenario analysis. These are all independent terminology. Surety bond, fidelity bond. Surety means if any third party, if key supplier does not deliver on time, then still the company will it's like an insurance. The company will pay you penalty. Okay.
Okay.
Just read this. It's easy, self-explanatory only. Quickly read this.
Done, sir.
Is it over? Yeah, it's
Yes.
over. Fine. We'll stop now here.
Okay,
Okay.
sir.
So next we can start with FSA then. Okay.
Okay.
Okay.